So real quick, how many people are cattle producers? Several. Crop producers? Couple. Of the crop, is that hay, grain, all the above?
Grain.
Grain mostly. And how many people are farm, 100% no off the farm income?
That include retirees.
It could. And the reason I asked that really is the idea of some of the tax benefits that come as a factor of you qualifying as a farmer. And the big issue there is that, well, first of all, the IRS has many different definitions of what a farmer is, what farming is. But if you're a farmer and more than 2/3 of your total gross income comes from farming, then you can take advantage of the estimated tax payments, which means that you make a single estimated payment per year, which is the 15th of the month following the end of your accounting period. For most people, it's a calendar year, so it's January 15th. If you're not going to do that, you're going to pay your full tax liability, then your tax liability is due March 1st, or as the IRS puts it, by the 1st of the 3rd month following the end of your accounting period. That's a big benefit for farmers. If you qualify as farming, 2/3 of your income comes from farming, you don't have to make quarterly tax payments most of the time. If you've got off the farm income, then you're probably paying in anyway throughout the year, and you're probably following April 15th on that. Another benefit is you get to use cash accounting or cash basis accounting, which is where you're just reporting the income and expenses in the year in which they occur. You don't have to keep up with inventories and things of that nature, although you should for management decisions, but you don't have to for tax purposes. Another benefit there is the current year deduction of fertilizer and lime. Jumping ahead here a little bit, because we haven't talked about depreciation yet, but fertilizer and lime typically is applied in a year, but you typically get benefit from that fertilizer, depending on what it is, for more than 1 year. But as a farmer, you get to write all those expenses off in that year. Another option is farm income averaging, and we've seen a lot of farm income averaging occur the past few years because a lot of especially grain producers in the past few years and now cattle producers are seeing more profitable years than they've seen in the years past. So they've chosen to do some farm income averaging, and what that allows you to do is basically use unused portions of previous year's tax brackets to try to lower your tax liability for the current year. And we'll go into that in more detail. So, one of the things that Don asked me to talk about that I left out of this was what is an expense, or what is a deductible expense. So, although you don't have a slide there, I want to talk about that a little bit before we get into depreciation. So, do we feel pretty comfortable with what a deductible expense is on the farm? What shows up in the bottom half there, the Schedule F? Typical things: seed, fertilize, chemical, those kind of expenses. Repair expenses are all deductible expenses. One thing that we see a lot of, or where there's sometimes some confusion, is with loan payments. Your loan payment, if you've got a loan payment on land or equipment or even your operating note, the loan payment itself is not a deductible expense. It's just the interest associated with that payment. If you look at, and I really am getting ahead of myself here, repairs is one of those issues. I mean, on the Schedule F, there's a line item for repairs. We all know what a repair is, repairing your truck, tractor, whatever the case may be. If you actually look at the IRS's stipulations on what constitutes a depreciable item versus what constitutes a repair expense, sometimes that gets a little bit muddy. And I'm not going to sit here and tell you that you should do it one way or the other. Definitely not telling you to go tell your accountant they've been doing it wrong. But just be aware that if you look at, once again, the IRS's definition of what is a repair versus what is a depreciable item, sometimes things that we typically call repairs could meet the definition of a depreciable item from the IRS's perspective, because they use a very vague terminology. If it is something that increases the value or the life of that asset, then it is depreciable. Arguably, a new set of tires would increase the value or the life of a tractor. Now, once again, do I expect to ever see anybody actually depreciate a set of tires? No, I don't. But just be aware of that is one of those areas that does exist. Don't think it's a big deal. Never heard anybody getting in trouble with that. But I would be remiss if I did not mention that. So one of the, I feel like most of those, your variable costs, your seed, feed, chemical fertilizer, repairs, all that, is pretty straightforward. We pretty much have a good understanding of those expenses, that they're, directly written right off on our Schedule F. One of the expenses that sometimes is a little bit more confusing or a little bit harder for people to grasp is the concept of depreciation. That's what I want to talk about next. In general, depreciation applies to the purchasing of or making improvements to your farm property, such as machinery, equipment, livestock, or structure, with the useful life of more than 1 year. Okay? So any kind of capital asset purchase is technically a depreciable asset. A tractor, a truck, a breeding cow, a heifer, fencing, if it's a new fence, grain bins, hay storage facilities. Trying to think of some of the other more common ones. Sometimes even roads are depreciable. A lot of times we just count that as a property expense when we make a new road across the farm, but that technically would be depreciable as well, or added to the cost basis of the property. In general, the cost of these items cannot be deducted in 1 year, but you have to spread the expense or that capital asset over several years. The life of those assets defined by the IRS versus reality usually do not coincide with each other. Oftentimes they're completely different, but we have to use what the IRS says the useful life is for certain assets. There are some exceptions to this, which is Section 179 expensing, where you can write off the expense all in 1 year, or bonus depreciation. We're going to talk about some of the issues associated with those two items here in a minute. Typically, the convention for depreciation is 150% modified accelerated cost recovery system, or MACRS. There are some other options, but most of the time, for most farm equipment, you're going to use MACRS. There are clear rules when depreciation applies. If it has a useful life of more than 1 year, then it's depreciable, and you set it up on depreciation. You spread the expense or the cost of that item over the years defined by the IRS. One thing in lean times I tell people is to use depreciation to your advantage. Oftentimes we're trying to minimize a tax liability. Sometimes we want to put something over in repairs that really is a depreciable expense, or we want to put something in property maintenance that really is a depreciable expense. If you're doing tax planning and you realize that you're going to have a loss for that year, or you're not going to have a very high income, sometimes it is to your advantage to depreciate as much as you can, because all you're doing is just shifting those expenses to future years when your income could be higher. Once again, I don't see a lot of people doing that. I work with 65 farms firsthand, and I can think of one individual who does that. Whenever he's going to have a lean year, he will make sure that he really maximizes depreciation for future years. Here are just some examples of the class lives as determined by the IRS. 3-year property catches non-race horses, 12 years of age or older, for those of you who have a horse that you use for your farm. Over-the-road tractors, so like a tractor trailer, the tractor part is 3 years, defined by the IRS. Breeding hogs are 3 years. 5-year property, airplanes, for all of you that got airplanes out there, that's 5-year property. Your breeding cattle, sheep, a heavy-duty truck, any wind energy property, we are seeing more and more of that in certain parts of the state, or interest in that. The farm share of your personal automobile, you know, if you've got a personal vehicle that you're setting up on appreciation, a share of it, that's 5 years. Computers are 5 years. And, you know, some of these just blow my mind. You know, an over-the-road tractor is going to last more than 3 years in most cases, I hope. Computers are almost obsolete now after a few years, but they're now, you know, the IRS still considers them 5-year property. 7-year property captures most everything as far as farm equipment, machinery. Fences are under 5-year property. Office equipment is 7-year property, excuse me. And then anything that is not specified by the IRS that's agricultural related is 7-year property. So any property that does not have a class life, it automatically defaults to 7. Once again, I point these out just to drive home the fact that these class lives as determined by the IRS really do not meet your expectations or reality, but it is what it is, and that's what we have to use. Sometimes it can be advantageous. Section 179, expense election. More specifically, the IRS or the Internal Revenue Code, Section 179, sometimes called accelerated depreciation, is one of those options that you can use to depreciate the entire cost of an asset, assuming that it fits into certain class lives, all within 1 year. Typically, those class lives are 7-year class lives and some 10-year property that are single-use agricultural facilities. The problem here is that right now, we have no idea what these limits are going to be. Well, we know what they're going to be, but they're going to be substantially lower than what they've been in the past. So for right now, without any congressional action, we've got a $25,000 write-off with a $200,000 cap. So as of right now, you can write off $25,000 of, you know, let's say equipment purchases in 2014, all in 1 year, assuming that you only spent $200,000 on new equipment or on new assets. If you go over that $200,000 limit, then your write-off amount is reduced dollar for every dollar that you go over. So if you spent $225,000 on assets, you have no Section 179 expense ability in 2014. In 2013, we had a $500,000 expense election with a $2 million cap. So these are drastic changes that have occurred. It's just gossip, just rumors, nobody knows. But this came out in February of this year in the CFO Journal, which is owned by the Wall Street Journal. They were lamenting the fact that the bonus depreciation expired, bonus depreciation in Section 179 had expired, and it said companies are still optimistic. Farm machinery seller Deere & Company said last week it expects the tax break, which has propelled farm equipment sales in the past years, to be renewed. What this told me was that there are many large companies that are spending millions of dollars in Congress lobbying to try to get this changed. Most people feel as though it is going to be changed, but to what level, we don't know. So making any decisions beyond what is known right now, which is a $25,000 write-off with a $200,000 cap, is really just a pure gamble. They did us this way in 2012. They made a change. It was up in the air. They didn't actually decide until January 2013 and made it retroactive, which makes planning really hard for some farmers. The problem was that in 2012, when it was up in the air, the change was drastic, but I would say 90% of Kentucky farmers would have been okay in either way it turned out. The problem is now there's a lot of farmers in Kentucky that have used this Section 179 to manage their tax liability that, well, they're going to have a rude awakening if something doesn't happen. Their tax bill's going to go up. Things to remember, the midterm elections are now over. We knew that we weren't going to hear anything on it until after the midterm elections. Now it's just a wait and see game. You know, when are they going to do something? Is it going to happen before the end of this year? Is it going to happen in the beginning of 2015 and make it retroactive? Another beneficial depreciation tool that existed as well was bonus depreciation, which is also known as additional first-year depreciation. It could be used only on brand new equipment. If you wanted to, with the Section 179, any assets that you purchased that fit into that class life of 7 to 10 years could be depreciated in that year, whether it was brand new or used. With the bonus depreciation, it was only on brand new equipment, and it was with anything of 20 years or less. In 2011, we had 100% deduction, so essentially it was as good as Section 179. In 2012, we had 50, and in 2013 we had 50, and right now we had none. So without congressional action, we will have no bonus depreciation. Nothing is allowed. Once again, it's just rumors, it's just hearsay, it's just reading articles and talking to accountants, and there is less, in my opinion, and it's just anecdotal evidence, there's less faith that this will be brought back than there will be Section 179. But we don't know what they'll end up doing. So that's just some depreciation stuff. What is depreciable, class lives, and then some of the tax tools out there that you can use to optimize your depreciation situation, depending on what Congress ends up doing. When you talk about depreciation, it's important to talk about depreciation recapture. So whenever you have an asset that is set up on depreciation and you sell it, what happens? How do you account for the income from that sale? We've got two scenarios. We've got ordinary gains and we've got capital gains. We're going to go through a couple scenarios here, try to shed a little light on how each is treated and under what circumstances. So gains that are realized when a taxpayer disposed of an asset that has previously provided an offset to ordinary income. Okay? So once again, you set a tractor up on depreciation or a barn, whatever the case may be. That depreciation expense has offset your ordinary income. It's come off as an expense on your Schedule F. It's lowered your taxable income. When you sell that, you've got to recapture the amount of depreciation that you've taken up until the selling price. Okay? Results in either a 1231 gain, which is a capital gain, or a 1245 gain, which is ordinary income. I think this is easier to show through examples than it is just trying to talk through the noise. So let's assume that we have purchased a tractor for 50 grand in 2005. So by now the tractor is fully depreciated. It's a 7-year class life. Another little note on that too is under 150% declining balance or the makers. It actually takes 8 years to depreciate a 7-year item because you only get to take half the first year. Just a little caveat there. But if we bought it in 05, even though it's 7 years, it takes 8 years to fully depreciate it. It would have been fully depreciated in 2013. It's now 2014. Once again, that $50,000 that we took off each year in 05 through 2013 offset our ordinary income. Assume that now in 2014 we're going to sell that tractor for $30,000. We have to recapture that depreciation in the amount of that sales price, okay? This is going to be ordinary income to us, but it's not going to be subject to self-employment tax. Does that make sense? You've got to count the expense of that tractor each year for 8 years. You used all that expense that necessarily offset your ordinary income. You turn around and sell that tractor, that is a ordinary gain, ordinary income. If you had sold the tractor for $55,000, instead of, then 50 of it would have been ordinary income, and 5,000 would have been treated as a capital gains. So one way you can think about it is whenever you sell something for more than what you paid for it, then you're going to get a capital gain. If you sell something for less than what you paid for it, in general, it's going to be ordinary income. It's going to be ordinary gain. This is really confusing, and I cannot tell you how long it took me to get this straight in my head. I automatically thought, longer than I want to admit, that you sell a tractor, it's capital gain. No, it's not. It depends on how much you paid for it, etc. We also have a situation where they call it netting your 1231 gains, okay? So sometimes even when you have a 1231 gain, it's still treated as ordinary income. If you have had 1231 losses in previous years that were taken off as ordinary losses, sometimes 1231 gains and losses are called the best of both worlds, okay? When you have a 1231 gain or 1231 net gain or a capital gain, then it gets taxed at the capital gain rate, which is a much more favorable income tax rate. If you have a 1231 loss, then it's an offset to your ordinary income. Does that make sense? So if you have a loss, a capital loss some year on an investment or something like that, that's going to just offset, it's just going to come off your income. So if you've had 1231 losses in the past, there's a 5-year look-back period for 1231 gains. Okay, so if I have a 1231 gain this year or a capital gain here in 2014, but I've had capital losses in the previous 5 years, then I have to recapture those capital losses that I've had in the past. So a portion or all of your current 1231 gain could be treated as ordinary income to offset the 1231 losses that occurred in the previous 5 years. So going back to the tractor example, tractor purchased in 05 for $50,000, sold for $55,000 in 14. Assume that our farmer Severin here had the following 1231 situation in the previous 5 years. 2001, the net 1231 gain or loss was 0. In 2010, it was 0. She had a loss, a capital loss in 2011 of $2,500. Nothing in 12, and then she had a positive capital gain of $700 in 2013. When we net these out with our 5-year look-back period on our 1231 gains, this is what results, okay? We start with a $5,000 net 1231 gain or a capital gain for 2014. And we don't have to worry about 9 or 10 or 12 because they were zeros. But we add our loss of 2011 to our gain of 2013, and we get a remaining 1231 loss of $1,800 in that previous 5-year period, okay? We treat $1,800 of that $5,000 capital gain in 2014 on the sale of that tractor as ordinary income. The difference we get to treat as a long-term capital gain or 1231 gain. So this will be added to your ordinary income and will be taxed as such. A $3,200 amount will be treated as a capital gain and taxed at the lower capital gain rate. Does that make sense? Just to recap on that, we're selling the tractor for $5,000 more than what we paid for it, okay? We've got a $5,000, and I've kind of oversimplified this because I haven't done any depreciation recapture, but we're just assuming that we've got a $5,000 1231 gain off that $55,000 tractor sale. But we have to go back and essentially pay back the 1231 losses that we've had in the previous 5 years. So even though we've got a $5,000 gain, it all does not get taxed at the favorable capital gains rate. Some of it gets taxed at the ordinary income rate.
Question. So 51,800 is ordinary income, pay at the ordinary income rate?
Yes.
3,200?
Yeah, if I did,
They don't care what capital gains or losses you wrote off, it's all of them combined? It doesn't matter if it's on that same piece of, well, it wouldn't be the same piece of equipment?
right, it's whatever capital gains or losses that you've had in the previous 5 years.
Do you know what the rate is for capital gains? Is it still 15%?
Tammy, will you?
For now, unless they change it with the new legislation.
Yeah, they were thinking of changing it, what, 2 years ago?
Right, and they did not, they have not done it yet.
Right. But yeah, thank you for pointing that out, because I was not careful in my example here and did not get the depreciation recapture. You had to recapture the $50,000, just like you did in the previous example, as ordinary income. So yeah, it would be a 51,800 ordinary income situation, and then a $3,200 capital gain on that total of 55,000. I've had farmers that have gotten bit real hard because of this. You know, they were selling equipment throughout the year for whatever reason. Maybe they had a change in their production plan, it doesn't matter. But, you know, they were thinking, it's all gonna be capital gains, no big deal. But you don't have to sell too many tractors before you get yourself in a tax situation if it's gonna be ordinary income. So why is this? The rationale, once again, is just that it's the best of both worlds scenario. In the past, when you had a 1231 loss, it was treated as an offset to your ordinary income. So they look back 5 years, and you essentially have to repay that loss if you have a gain, and you repay that through the treatment of that gain being treated as ordinary income. You may not agree with the rationale, but that's what it is. I'm sorry.
Are you paying based on the rate that it was at the time you experienced the loss, or is it under the current?
It's under the current, it depends on where your ordinary income is in the current year, is that correct?
I didn't hear his question, I'm sorry.
When you recapture your 1231 losses, you pay the year in which it increases your ordinary income.
That's correct.
Correct. Yeah, so if you've got a high ordinary income this year and you also sold several pieces of equipment, then you could have a real high ordinary income, a lot higher than you ever thought you were going to have. And Uncle Sam is going to like you very much. So what about depreciation recapture from the perspective of selling something before it's fully depreciated? Assume that farmer, oops, that's not my pointer. Assume Farmer Fred purchased a $1,500 wagon in 2012. This is the depreciation allowance that would happen each year. So for 2012, because of the half-year convention, $162 in depreciation, if you will. 2013, $287, and $113 in 2014. Results in an adjusted basis of $939. And all this is just adding those three up and subtracting them from the $1,500. So the adjusted basis is $939. If Farmer Fred sold that same wagon, $1,200 in 2014, he would have to treat $261 of it as ordinary income. And that's the difference between, I think if I'm doing my math right, I hope. The difference between the 1,200 and the 939. So is it the difference between his selling price and his adjusted basis is a gain and treated as ordinary income.
What happens when you depreciate all this stuff and you decide to retire and quit farming? Is there any tax liability there?
Usually you can't afford to. Excuse me. I've actually got farmers, first-hand experience, that have been trying, I literally mean this, been trying to retire for 5 years, but they don't want to face the tax liability that they've got. Yeah, the tax liability is the same. I mean, if you say, I've had enough of this, you start selling equipment.
But what if you don't sell the equipment?
You just decide
I
to
mean,
quit
then
farming.
your estate would be responsible for it?
Right,
Somebody's gonna want their money, the IRS is.
right. So do you know what happens when you spell the IRS? theirs. If you put the two together, they're gonna get it, okay? Whether it's in your lifetime or your heir's lifetime. And I don't, it sounds like I'm really harsh against the IRS. I like to poke fun at them because they give me so much pain in my job. But, you know, I'm not completely against them. I mean, they serve an important function. Are there any IRS agents in here today? I can eat brownie points. But no, quite seriously, yeah, if you decide that you're going to quit farming and you hold on to those assets, then they get passed to your heirs. That gets into a different situation on whether it's gifted or heired to them. If it passes to them through your estate at your death and they get a stepped up basis, if you give it to them before you die, then they get the basis that you have in it. If it's a fully depreciated item, then their basis is going to be 0. So there's some tax issues there for your heirs, depending on what you want to do. Did that sufficiently answer your question?
Yes.
Okay. So cattle, I mean, many of y'all are cattle people, or you've probably been cattle people in the good times and the bad times. Right now, we're seeing some pretty good times in the cattle world. So before, well, I actually know some people that did this year. They sold cattle at a very good price, purchased back a lot of breeding animals, and had planned on writing those off, Section 179 expense, to minimize their tax liabilities. Let's assume that they did that, and let's assume that that still holds, and let's assume that Congress decides to work together and they get laws passed in a timely manner. What happens if, we can drink, it's getting close to Christmas. What happens if we do buy these animals this year and we write them all off? You know, let's say we buy $25,000 worth of heifers, we write it all off this year to reduce our tax liability. But we turn around and sell those animals next year. We change their mind. It's going to be ordinary income. Also had farmers do that and get themselves caught in trouble. You know, I'm going to buy, like I said, I've got extra cash right now. I really need some heifers. I'm going to buy some heifers. I'm going to write them all off this year. It's going to help me on my taxes. Win-win. The next year comes, whatever reason, they change their mind, somebody offers them a whole lot more money, whatever the case may be. They sell them. What you wrote off as Section 179 expensing in the previous year is going to be ordinary income the year in which you sell them.
So if you sold them off 25,000, but they were pregnant or something, you got maybe 30,000, 5,000 would be capital gains?
If you'd held them for more than a year.
It has to be more than a year.
Yeah. So if you bought $25,000 worth of heifers, say here in 2014, you write them all off, you sell them as bred heifers in August of 15. I have no idea if that math works out or not, but let's say it does, and you get 45,000. It's all going to be ordinary income. Cattle basis. What about cattle basis? This applies to market animals. So those of you who background or buy market animals and took weight on them to turn around and sell them, the cost of that purchased market livestock are only deductible in the year in which the animal is sold. That comes as a surprise to some people. It is what it is. So let's say that I'm backgrounding cattle and I go out and spend $50,000 on cattle today, and I'm going to background those steers until sometime next year. I can only count the cost of those animals on my 2015 income taxes. I cannot count the cost of those animals on my 2014 income taxes. And technically, any trucking charges that you have getting them to your farm, you have to hold off and not count that as well. It requires detailed record keeping, especially if you're doing a lot of that, buying and selling. Now, what about the feed associated with those? You can go ahead and deduct that as it occurs. The IRS is smart enough to know that. I mean, if you want to be exceptionally technical, you should probably break all that out. But the IRS realizes that nobody's gonna do that. It would be an undue burden on you. So the vet expenses and stuff of having those animals, you can write off as a deductible expense when they occur, but the actual cost of the animal, you cannot. There was something else I wanted to say about that. Oh. Not that I advocate by any stretch of the imagination doing things that are immoral or illegal on your taxes, but I often have people ask me, how does the IRS know? I don't know how they know. I don't know that they would know. But I know that you gotta be able to support yourself in an audit. You know, if they show up and do an audit, especially if you have one that knows anything about agriculture, this is one of the areas they're gonna ask to look and see records on. So you may be tempted to do things in the short run for short run gains, but if you ever get audited, you may regret making that decision. What about selling breeding cattle that you purchased? This goes back, it's treated the same way as in the tractor example. You know, if I buy, what's a cow bringing now? Not the amount of money I know, but goodness, see, you got more than I was aware of. Let's say that I buy a $2,200 cow, and you know, I keep her for 5 years, and I sell her for $1,800. I've got to recapture all that depreciation up to the amount which I sold her for. If the sales price is greater than the purchase price, then you're going to get in the same ordinary income capital gain scenario. So we back up several years before cattle prices went up, and I bought a cow many years ago for $1,000, and cattle prices went up and I sold her for $1,500. Assuming she was fully depreciated, then I would have $1,000 ordinary income and a $500 capital gain if we don't take into account any 1231 netting that occurred. What about breeding cattle that are held for greater than 24 months? So regardless of whether they're raised or purchased, if you've held the animals longer than 24 months, they qualify as a capital gain. If they're held less than 24 months, then it's ordinary income. So if I raise heifers and I retain that heifer for less than 24 months and sell her, then it's going to be ordinary income. All right, crop insurance and involuntary conversion of drafted and breeding animals. Probably going to just kind of skim through the crop insurance deferral. Just know that you can defer crop insurance if there's certain criteria that can be met, that has to be met, but if you have a crop insurance claim, you can defer. Typically, you can defer that crop insurance to the following year. You need to be able to show that you typically would have sold crop in the following calendar year. And there's some stipulations there as far as how much of it can be deferred with the new insurance policies. But if you got questions on that, let me know and we can go into more detail. That was a big deal back in 2012 whenever we had the droughts. There's a lot of crop insurance deferred. And it was being built in 2013 and a lot of taxes that were due. So what about involuntary conversion of draft or breeding animals? If you refer to the Internal Revenue Code section 1033E, a producer who sells more draft, breeding, or dairy animals than normal due to weather-related conditions can defer the gain up to 2 years. You must replace those animals with like animals within that 2-year period. A disaster declaration is not required, but you must be able to show that weather-related conditions forced your sales to be above normal for that year. We've had this in Kentucky in 2012. A lot of people didn't know about it. Some people did. It wasn't used as much as it could have been. You can actually delay the gain up to 4 years if there's a persistent weather condition. So I would assume that our farming counterparts in Texas probably have been using this option with their drought, or over in California. If the persistent weather condition lasts 3 years or longer, and it makes it infeasible to replace what you sold with identical livestock, then you can replace that with any property. You can replace what you converted it to any property. The key to this is, being able to prove that their weather conditions did force you to do that and keep it really good records. So an example of this, let's assume that we normally sell 5 cows. This year we're selling 20 because there's a drought. We can defer the gain of 15 cows. We're selling 15 more than what we normally would if we replace those within 2 years. The tax basis of the replacement livestock is equal to the basis in the livestock plus any additional amount invested in the replacement livestock that exceeds the proceeds from the sale. So, if you had $500 a head in basis left in the ones that you sold, and then you bought some for $1,500, your new basis would be $2,000 per head. Kind of getting out in the weeds there a little bit, but that is important. If the animals are not replaced or replacement cost is less than the gain, then the difference must be reported as a gain for the sell year by amending your tax return. So if you have involuntary conversion and you don't purchase back as many as you sold, then you got to go back and amend that year's tax return and count that as a gain in that year. Sounds like a lot of trouble to me, but that depends on your individual situation. So assume the animals were raised, there's a zero tax basis, and you sold them for $500 each. They're really skinny cows and they just weren't, they're just skeletons. You've got a gain of 17.5, which would be the 500 head times the 15. In 2 years, you've purchased, within 2 years, 15 more head are purchased for 500. The tax basis in the replacements would be 0 because you didn't have a tax basis in them anyway, because they were raised. If within 2 years, 15 more head are purchased, but for 600, the tax basis in the replacements would be 100. It'd be the 600 that you paid for them minus the $500 basis that you already had, minus the $500 proceeds from selling this. Once again, wow, I really spent some time on this one. Now assume that they were purchased with a $200 remaining basis and sold for $500. The basis would be $200 each if the replacement costs $500. If the replacement costs $600, the tax basis in the replacements would be $300, which would be the $600 minus the $500 sales proceeds plus the $200 remaining basis. Once again, I don't think you should concern yourself too much with those details until you get to that point. If you find yourself in a situation where you feel like you're going to have to sell cattle because of a weather-related condition, go talk to your accountant and figure out exactly what the tax consequences are. Know that it's an option. Know that you can defer some of that gain, but please sit down with somebody who's got your depreciation schedule, understands the details, and walks you through it, because you need to make sure that you are making the right decision and you're not going to find out when it's time to write the check that you made a boo-boo. One of the things when you make this election, you've got to include a statement with your return that gives your name, address, and any federal ID numbers that you have, evidence of the weather-related conditions that forced the sale, explanation of how that sale is related to those conditions. You've got to list the number and kind of animals sold, the number and kind that would have normally been sold, the computation of realized gain on that transaction, and the amount of income that you are going to postpone for that 2-year period, or up to that 2-year period. Internal Revenue Code Section 451E says that you can defer for 1 tax year the income of certain livestock sold due to weather-related conditions. If you do it under this section of the IRC, then your area must be federally recognized and declared eligible to receive federal assistance for natural disaster. Once again, you've got to have sales above normal, animals that are not replaced, and the elected gain is reported on the following year's tax return. So in that situation, if you don't plan on buying animals back, you just happen to be in a situation where you had to sell more, but once again, you're not buying them back, you can defer that gain for a year. But to do that, you must be in a federally declared disaster. And also, to do that, your primary business must be farming. You gotta be using the cash method of accounting, which most farmers do, not all, but most. You must be able to prove some kind of, have documentation that prove that normally you would not have sold those animals in that year, and that the weather-related disaster caused the sale of that livestock. And remember, once again, that you've got to be in a federally designated area that is eligible for federal assistance. Sometimes what they're trying to avoid here is people taking advantage of a bad situation and selling animals and trying to defer the gain. So you have to provide some kind of documentation that shows that the weather-related conditions caused the sale of that livestock. This is where you really need your accountant to help you do this, because you need this documentation. Your accountant has the resources available to know what kind of documentation is needed, how to document it, so that you protect yourself in case you're ever audited. Same kind of scenario when you make the election, as far as they want to know everything about you. So what about farm income tax averaging? This can be very, very beneficial. I think it's a very underutilized tool for farmers to lower their tax liability in a year in which they have abnormally high or higher than usual farm income. All you're doing is trying to smooth your tax liability over time. You can elect to spread your current farm income over the 3 previous base years, and it's an equal proportion that is taken from this year that's spread out in those 3. This is another one of those scenarios where it's easier to go through an example and see how it works than just trying to talk through it. Assume that a married couple has the following net farm incomes for these years. Let's assume for 2014 they had $75,000 net farm income. That would put them in the 25% marginal tax bracket. 2013 they had a $25,000 net farm income, a marginal rate of 15%. In 12 it was $10,000, which was the 10% marginal bracket. In 2011 they had a loss, so they were in the 0 bracket. And these tables here come from Forbes, just to give you, sometimes people like to see what the tax brackets are. This is the tax rate for single individuals, and this is for individuals married, filing joint. I didn't include the tables for head of household or anything like that. But that's just for your reference so that you can see these change a little bit every year. They're adjusted up a little bit for inflation. And sometimes we even add a tax bracket, depending on who's in charge at the time. We got this one added. Tammy, did we get 35 and 39, or was it just the last one that was added? Just the last one. We got this one added last year.
I think it's just coming
So assume that, okay, in 2014, this married couple's got $75,000 of farm income, and they're electing to do farm income averaging on all of that. You don't have to elect to do all of that income. You can choose a portion of it, which gives you even more options to strategize in your farm income tax averaging. But let's assume for simplicity that they've decided we're going to average that whole $75,000. Because it's proportional, $25,000 goes back into each previous 3 base years, but it goes into $25,000 at a time. So you can't choose to, we go back here, we can't choose to put $65,000 in 2011 and $5,000 in 13 and $5,000 in 12. We've got to put an equal proportion in each year. Okay, so 2014, our elected farm income of $75,000 is averaged. We put $25,000 in 13, which adds to the $25,000 that was already in there. It gives us a taxable income of $50,000. The tax on that was $37.50. In 2012, we had $10,000 already. We add $25,000 to it. Gives us a $35,000 income. That's also $37.50. Don't think I did my math right. In 2011, we had a loss, but we add $25,000 to it. Gives us $17,000. dollars at the 10% marginal rate, that's $1,700. If we average our income, like I said, that number's not right, I apologize, but the key point here is if you average that income, instead of paying on the 25% marginal bracket, in 2014, had they not elected to average their farm income, their taxes would have been $12,278, but with the averaging, it's less than that, it's $9,200. That can really be beneficial for farmers. Like I said, grain farmers have used that a lot because their incomes went up significantly over the past few years. Now we're getting to the point where they've had so many good years that averaging is not going to help them. But people that are engaged in cattle that may be having a higher farm income this year than what they've had in previous 3 years, you can spread some of that income out in those 3 previous base years and lower your tax liability for this year. It's easy to do from the tax preparer's perspective, especially if you've been with the same tax preparer. Most tax preparation softwares, calculate it fairly easy. Mention it to your tax preparer, see if you can benefit from it. Not everybody will. There's some people that have had their incomes high enough that it is, they're not going to lower their marginal rate for this year. But for some, I've seen it save thousands and thousands of dollars in tax liability. So what are some other tax management options and areas of concern? Prepaid expenses. One of my favorites. As a farmer, you can pay for certain farm expenses in 1 year with the intention to use them in the following year and get to count that expense in the year in which it occurred. See this a lot. Feed, supplies, fertilizer, fuel, things of that nature. You're allowed to deduct those expenses in the year they were purchased as opposed to the year in which they were used. In general, you're allowed to deduct up to 50% of the current year farm expenses as determined by your Schedule F categories. There's some caveats to that. If you are going to have a substantial change to your farming plan, then you can exceed that 50% threshold. The 50% rule is the safe rule, but the way in which it's written with the IRS, you actually have quite a bit of flexibility to prepay more than 50% of this year's expenses and count of next year's expenses and count them off on this year's taxes. From a financial perspective, to me, this is the first place to start if you find yourself with extra cash and you're wanting to, or even if you don't have extra cash, even if you've got to borrow the money, depending on what the interest rate is. If you find yourself needing to lower your tax liability, this is one of the first places that I like to start. Because you're going to use these inputs later anyway. Once again, it depends a little bit. I mean, if a lot of times you can get cash discounts if you prepay, right? I mean, if we, if we're doing crops, all the seed houses offer pretty attractive incentives in the fall up to the beginning of the year. Sometimes you can get volume discounts on feed if you purchase more. You don't want to prepay expenses that you expect to go down in price. We've seen a lot of volatility in feed prices over the years. If we're expecting feed to go down after the first year because commodity prices are going to go ahead and go down, it may not be advantageous to prepay feed. You may want to wait and get it at the cheaper price. Same way with fertilizer. I remember several years ago, you could always get fertilizer this time of the year cheaper. That's kind of been turned on its ear many times. The farmers I deal with, you get fertilizer cheaper when it's planting time than if they prepaid it in the fall. But that is one option to help lower your tax liability. Here are specifically the allowances for exceeding that 50% deduction limit. If there's been a change in business operation caused by unusual circumstances, what's unusual circumstances? I don't know. Your cow smiled at you, that was unusual. It talked to you. I don't know, but that's how it's written. So it's pretty vague. It leaves the door kind of open, I think, in my opinion. Or if your total prepaid farm expenses for the preceding 3 years is less than 50% of your total other deductible farm expenses for those 3 years. So if you haven't done 50% every year in the previous 3 years, then this year you can do more than 50%. And once again, the way they're looking at that, so if your 2014 Schedule F, you know, you're gonna have $20,000 in feed expense, then, you know, by the 50% rule, you could prepay $10,000. Unless there's an unusual circumstance, then you can do more. What about leasing? Are many people in here lease equipment, or is there any interest in going into much detail on leasing versus purchasing?
So what percent of land?
No.
Okay.
Not from the perspective that I'm approaching it from. I'm approaching it from the perspective of, you know, you buy a piece of equipment, you set up an appreciation, you get the depreciation expenses versus leasing it and counting that off every year. There's a huge interest in leasing right now, largely because of the Section 179 expensing that's up in the air. There's some advantages to leasing. You know, I guess I'm going to get into this start anyway, but you know, less money up front, you got more flexibility. The bad thing is you don't own it. You got to pay for repairs on it, typically. And then the lease terms can be a disadvantage. Some disadvantages of buying is, you know, the higher initial cost, like I said. It's more costly to upgrade equipment if you're in one of those positions. Crop guys are real bad about this as far as the new technology. You know, we can't have a combine that's 5 years old. It's not quite fancy enough. I say that in jest, and I'm really not poking fun at them. Well, I do to their face because I like to rib them a little bit. But, what is best to do? It really takes a lot more analysis than just the key points that sometimes you'll see in some publication. To really address the issue on, and this would work, taking this approach would work on purchasing land versus leasing land. You need to look at the net present value of the after-tax cost, okay? You need to look at the interest rates on loans, the lease payments, the marginal tax rate, the time value of money after a tax discount rate. It becomes a lot more complex if you really want to answer the question, is it better for me to lease this asset or purchase it? But there are tools out there that can help you make that decision. Specifically, University of Illinois has done a very good job developing a lease versus buy decision tool, if you will. But like I said, it gets a little bit complicated just because there's a lot of balls in the air there that you're trying to pin down and figure out, and accounting for the time value of money as well. So what is better? It depends. That ultimately is the response. Another tax issue, since we were talking about tax management, is what I call creating the tax liability snowball. Those that can't afford to retire. I encourage strategic income tax management, okay? I think that you should use all the tax laws and tools to your advantage. Your goal should be to smooth your tax liability over time. You don't want to be paying a bunch this year and none next year. Those kind of situations are hard to live with. However, some of the tools that we use to minimize or even strategically manage income taxes have consequences. All that you're really doing, whether you're prepaying expenses or using Section 179 expensing or bonus depreciation, whatever tool that you're using, all that you're really doing is just pushing that income into future years. There is no avoiding income taxes. There's no way to get out of paying income taxes. Once again, anecdotally, but I work with farmers quite literally that cannot afford to retire because they have pushed so much income into future years. You know, their prepaid expenses, you know, they've already got 2015 crop paid for right now. Everything paid for. And the tax liability that they've created is just phenomenal. So you've got to be disciplined in your tax management strategies and understand that it's not just this year. You're creating consequences potentially for the future. The only way that you're going to get out of the income that you push forward is if you have some kind of disaster. You know, you have a drought or something like that that you are not protected against. And with a lot of the insurance tools that are out there, that's not even very likely, especially on the crop side of things. Especially when we have things that happen like increased tax rates. We don't know what the tax rates are going to be in the future, but we do know that we got another tax bracket that we did not have prior to 2013. Serious implications for your farm operation and your net worth. Especially if you're looking at retiring or downsizing and you don't want to have to sell land to pay the tax liability, which could also create another huge tax liability. So just be aware that any time that you are really managing your income tax situation and really pushing income in the future, those consequences can come back to bite you pretty hard. One thing that I think you should do, and I advise people to do, especially when it comes to things like this Section 179 expensing or the bonus depreciation, is not doing that on items in which you have a loan. You should try to not accelerate depreciation on financed items. You should try to match the loan terms to the depreciation terms. So if you don't do that, your future principal payments will almost necessarily be ordinary income. So if we buy a tractor for $25,000, we're going to pay it off in 5 years. We've got a $5,000 a year payment. I'm making some very general assumptions, no interest in that scenario. And we don't write that, we write that all off this year and we don't set it up on depreciation. That $5,000 that we've got to pay on that tractor over the next 5 years is going to be income to us. We're going to pay taxes on that income because we have nothing to offset that with an expense, because the tractor payment is not an expense. But if you had not written that full tractor price off and depreciated it, then you would have depreciation expense that would not be exactly $5,000, but would approach that $5,000 limit. I guess I got an example here. Here's $70,000 at 5.5% for 7 years. Your annual payment's $12,318. If you set it up on maker's depreciation, that's what the depreciation expense is on that item. So once again, you're not exactly writing, the depreciation is not exactly matched your annual payment, but it at least approximates it. Instead of having that much as income or having that much payment that you have to make with no expense to offset it, at least you're getting kind of close there in most years. And if it's finite, well, that's for 7 years. All right, one of my favorite topics. Farm losses versus hobby losses, and once again, I made this disclaimer before, I'll make it again. When we say hobby losses, we're not inferring anything about the size of your operation or your ability to farm or your seriousness to farm. Just in the literature, it's used, hobby losses is used to talk about this. And so I get this a lot from farmers that have not shown a profit in several years or have off the farm income and they've shown a loss on the farming. And so that you're concerned, you work off the farm or your spouse works off the farm off the farm and you also farm, and so you've got earned income off the farm, but your Schedule F is showing negative every year. A lot of times that creates some anxiety, like, oh no, the IRS is going to think that I'm just doing this for fun to offset my taxes. I understand the concern, but I don't think it's as big of a concern as you may think it is. So Congress says in order for you to be able to deduct an expense in excess of your income, you must be engaged in that activity that created that expense for a profit. Pretty straightforward. Profit in this context refers to income being greater than expense, where expenses include depreciation on capital assets. Pretty straightforward, right? You're automatically not considered a hobby if profit occurs in any 3 out of 5 consecutive years or 2 out of 7 for equine. Equine folks get a little bit longer there to try to prove that they're profitable. Let's say that you do not meet that. Let's say that you have not showed a profit in 5 years or 7 years. Just because you fail to meet that profitability test does not automatically make your farming enterprise a hobby venture. But it does give the IRS justification to look a little bit deeper into your operation. What do they look at? There are 9 areas of consideration that the IRS goes through. Do you carry out the activity in a business-like manner? What does that mean? I don't know. Do you wear a suit and tie out to feed the cattle? No. Do you handle it in a business? Do you have good records? Do you have good advisors? Do you come to meetings like this? Are you interested in trying to turn a profit? What is your expertise? Or the expertise of your advisors? Let's say that you're in the cattle business, but you have no idea a cow from a bull. You just happen to be in the business. And they pick up on that. That might cause a little bit of concern. What about your advisors? Are you writing out consulting fees to a farm manager who's never on the farm and also doesn't know the difference between a bull or a cow? That might be problematic. How much time are you investing in that activity? Is this one of those scenarios where, you know, you're spending a half an hour a week checking on the cattle and otherwise they're just out on their own, but you just happen to write off, you know, $60,000, $70,000 worth of expense off your income? You know, you need to be able to show that you are putting time and effort into this activity. Is there an expectation of asset appreciation? Hopefully so. You know, owning land, there should be a reasonable expectation of asset appreciation. There should be a reasonable expectation of asset appreciation just in your farming business in general. You hope that it grows over time and will be worth more over time. Have you ever done this before? Have you done this before and failed miserably at it? And you just keep starting a new farm every 3 or 4 years and writing off a lot of income. That might be problematic. Or if you've done this before and been successful, and this time around you just happen not to be successful, can be a plus to you. What is the history of previous profits or losses? You know, let's go back even beyond the 5-year period. Have you ever made income or profit? And also, what is the history in the terms of how mature are you in your farming? Are you a beginning farmer, or have you just started this farming operation? There's an expectation of losses anytime you start a business. Have you ever made any money? If you've never made any money, that may be an area of concern. Are you engaged in other income generating activities? Once again, if you're showing a huge loss year after year after year, but you just happen to have a huge income elsewhere, that may be probably. It doesn't mean it's going to be, but it at least allows them to ask questions. Are you having fun doing it? Because if you are, that's not liked by the IRS. They do not want you to have fun, period. So always wear a frown when you're doing your farming activities. And take pictures of yourself frowning. You know, the selfies of you frowning next to the cat. So literally, I would like to know, you know, how much heart disease and stuff this has caused people because of high blood pressure, because they're stressed out that they're going to get called out on being a hobby. I really don't think it's that big of a concern if you take time to document things. You know, keep good records. Keep a journal. Keep a journal of the extension meetings that you go to, or keep some of the back copies of the magazines and publications that you subscribe to that deal with farming. Have a business plan. That is a huge deal. If you have a business plan that says, I'm engaged in this, these are my expectations, even if you don't meet those expectations from a profitability standpoint, having a business plan to prove that you're trying to run this farm business in a business-like manner is a huge deal. I mean, one that, if there's no other reason to motivate you to do a business plan, do it to protect yourself from the IRS if you're in this situation. I've got farmers that have not made money in decades, but they're not. It is a legitimate business. I mean, they really, whether it's because of bad breaks or growth, so you have a bad break this year, then you go into expansion mode this year, then you have another bad break or whatever, you know, that's life. That's part of running a business. Just don't go around thinking you're automatically going to be in trouble for not farming and having a hobby. Now, there is nothing wrong with having a hobby. If you do choose to farm just from the perspective of a hobby, that's fine. But just realize that you don't get the same tax benefits as if you're doing it for profit. Yes, sir.
If you can convince them that your sole source of income, they cannot call it a hobby. I have had that experience.
That's your that farming is your only source of income. Yeah.
They can't do it. No matter how much you lose, it don't make any difference. If it's your sole source of income, they're stuck.
You're in good shape. I would believe that because, you know, where else, you know, how else are you living? I mean, even if it is a loss.
Well, your wife makes some income. You don't worry about his head. You just do it for yourself. So
Don't worry about it.
there's ways to.
And a lot of it too depends on which IRS auditor you get too, if you ever get pulled. True story. I mean, it didn't happen to me firsthand, but it happened to one of my colleagues in Illinois. They were working with a farm that got audited. IRS auditor came out and was just completely confused and convinced that that farm was engaged in fraudulent activity because they did not have a bull for every cow. It took a couple of hours for the farmer and the advisor to educate the IRS auditor that that is not the way it works in the bovine world. It is not monogamy. So it depends on who you get. Sometimes that can work to your advantage, depending on what auditor you get. One thing that can be a good deal is, depending on from whose perspective, from Tammy's perspective and my perspective, this scares me, that the IRS commissioner says that 2015 is going to be a miserable tax filing season. Gives you a lot of positive energy going into it, a lot of positive expectations. But because of budget cuts, you may not get your questions answered nearly as quickly, but there's not nearly as many field staff that can come out and do audits as well. It's just a reality. And the IRS does pick and choose from time to time who they audit. Sometimes they focus more on certain industries or certain types of businesses than they do others. I don't know where we're at right now. Luckily, I haven't had to deal with an audit, but I guess you can, if you're scared of the IRS and don't want them on your farm, you can be thankful that their budget has been cut. And it looks like a miserable upcoming tax filing season. The Affordable Care Act, which is technically the Patient Protection and Affordable Care Act, which is either affectionately or not affectionately referred to as Obamacare. There are two key provisions that come into effect for 2014. This is part of the reason that the IRS is saying it's going to be a miserable tax filing season. The two are the individual shared responsibility provision and the premium tax credit. I had to take this directly from the IRS. Sometimes you'll hear the individual mandate in media. The same thing as the individual shared responsibility provision. So for 2014, if you do not have health insurance, you're going to be fined for not having it. And you're going to be taxed for not having it. And this is how it's calculated. So for the annual payment is 1% of your household income that is above the tax return filing threshold for the filing status, or your family's flat rate dollar amount, which is $95 per adult and $47.50 per child, limited to a maximum of $285. But it is capped at the national average premium for the bronze level health insurance plan through the marketplace in 2014. So they delayed this 1 year. They delayed the penalty for businesses to 2015, but for 2014, you will have to pay this tax if you do not have health insurance. The other issue that goes right along with this, they have to go side by side, is the premium tax credit. If you bought health insurance through the marketplace and you are ineligible for coverage through an employer or the government, and you're within certain income limits, and you do not follow married filing separate return, then you get a premium tax credit. And there's specifications on what it is and when you get it, and you can choose to have that tax credit taken directly off your health insurance premium, or you can just pay the health insurance premium and get your tax liability reduced or get a refund for it. The important thing here is that to get this premium tax credit, you cannot be eligible for coverage through an employer or through a government plan, and you have to buy health insurance through one of the marketplaces. In Kentucky, that's Connect, K-Y-N-E-C-T. So you have to buy your health insurance through Connect to be eligible for the premium tax credit. Two other things that I want to mention briefly, and really it's just to raise your attention to them, don't want to spend a whole lot of time on them, is the net investment income tax. Came into effect in January of 2013. There is an additional 3.8% tax on the lesser of your net investment income, or by the amount at which your modified adjusted gross income exceeds certain thresholds. Here are the thresholds. I think the literature I've read is this only affects about 6% of the U.S. population because the income thresholds are so high. But just be aware of that there is a net investment income tax out there, so there's an additional 3.8% that could affect some people. And then we've also got an additional Medicare tax that became effective in 2013 as well. That's an additional 9% if you fall into these thresholds. So if you are married filing jointly and you make over $250,000, you're going to pay an additional 0.9% Medicare tax on those earnings. There's a couple really good resources out there for farm tax and farm tax education. One that I'm partial to is ruraltax.org. This is just a screenshot off the website. Got a lot of articles on there about farming, who's a farmer, depreciation. Really good resources for some basic farm tax stuff that can be referenced. And last but not least, publication 225 from the IRS. This publication is actually really good. It's very informative. It has just about everything in it that you'll ever need as a farmer. And you can actually read it without having a law degree, which is amazing. In fact, the Pub 225 is so well received by taxpayers that they are trying to fashion other IRS publications after it. Because, once again, I can pick it up and read it and understand it, which a lot of them I can't. That was my spiel. Any questions, comments, concerns, complaints? Did anybody catch on to my lies? Or
Any questions? Change speakers.
You'll notice that my cell phone number is on the front of your presentation slides there. Feel free to give me a call anytime if you have questions concerning your income taxes. Once again, I'll do my best to answer and point you to someone who can give you an answer. Dawn, was there anything that I missed that you told me about today?
You've done a good job covering what we had on the list, I believe.
Is there any tax topics that I didn't cover that is on your mind that you want to talk about?
I have a question.
Yes, sir.
What about farmers in paying a tangible tax on their equipment?
Paying tangible taxes on equipment.
Right.
Tangible taxes on equipment.
On farms, you are not supposed to. If it is on a farm schedule, a farm depreciation schedule, Kentucky is not supposed to charge you tangible tax.
So as long as you have the depreciation schedule, it's not required.
That's correct, and it ties to your Schedule F. If you have any equipment that would cross over to a Schedule C with a business or something like that, they can tax you a tangible tax rate.
And that's a good point. I didn't know the details, but I had some, because you get into that between Schedule F and Schedule C in agriculture. Once you take that agricultural commodity from its first use state, into something else, then it switches from a farming activity to a business activity, and that's where some people get caught with the tangible taxes. So, you know, if I've got a honeybee hive and I take that honey and turn it into candles, or to take the wax and turn it into candles, I'm no longer doing a farming activity, I'm doing a business activity. And that goes on Schedule C instead of Schedule F, and then you can get hit with tangible taxes.
Okay, let's bring you, go ahead and bring you all up in case you get a question.
Estate taxes passing your farm on.
Estate tax is passing your farm on. What is our limit?
Right now, it's $1 million, but they're talking about reducing that, or reducing it to make the taxes higher.
While I'm still alive.
But you've also got the gifting.
Gifting anything over 14,000 has to be reported that there's a $1 million. There are schedules, like classifications, A, B, and C. If it's a direct descendant, if it's a spouse, a child, they're not taxed, they're exempt. If it's a brother, a sister, a niece, a nephew, there are stages of that. Your best to do, if you're really looking at estate planning, see a tax professional. Because if you get someone that's into estate planning, they can really, it helps minimize the blow across the board to your heirs and you, because there is a difference, as he said, with giving it to them now in life versus in the estate. Their cost base is what it will mean to them in the future.
Thank you.
And as bad as I hate to, first of all, are there any attorneys in here? I hate to admit it, that is really good money spent either with a good tax accountant, preparer, or an attorney when you get into estate planning. But there's a lot of tools out there that you can use to minimize your tax liability and get assets over to heirs now, like there are a lot of things. And up to the 14, I mean, anybody in here can give me 14,000 or below, and you don't have to report it, so feel free to send me a check. Thank you all very much for your time. I appreciate being invited. Thanks for considering me.
Thank you.
And if I can be of any assistance, just let me know.
Well, as they said, my name is Tammy Bauman, and I'm a tax accountant working in Williamstown. I was told to keep mine short, so I won't keep you very long. You will get home before that game even starts. I was given a flyer and it said reducing your farm tax liability. I'm supposed to talk about record-keeping purposes and how that's important. How many of you take your stuff to your tax accountant in a shoebox at the end of the year? Do any of you use a spreadsheet or the farm record book currently? It helps significantly. If you look, I have a couple of handouts, I'm not going to read them to you. But bookkeeping and farm record keeping is very instrumental. Whether you're doing this for a farm or a business, it doesn't matter. There are a lot of reasons why it's important. But you get to November, as we've all heard many times tonight, cattle sales are really high. If I know today, November the 18th, that I'm looking at a very large gain, me personally and anybody else that prepares taxes are really comfortable with you calling and saying, I know what my expenses are. I just took cows to market. I'm gonna have this huge gain. I maybe need a piece of equipment. Somebody wants to buy this tractor. Do I do a like-kind exchange? What if I upgrade my tractor? What happens in March? What happens in April? If you follow the farm record keeping, whether it's this, in Excel on your computer, if you do it in a notebook like we used to do, just making good old-fashioned columns, you and I can sit down between now and the end of the year and we can pretty much nail down what's going to happen. That helps you with your planning. Whether it's the prepaid expense route, which, like Jonathan, I'm a little hesitant to really advise that unless you're not looking at estate planning and you are going to farm for a long time, because it does create a snowball that someday you're going to have to look at us and you're not going to like us. Because I'm going to tell you, you're going to have to send in a really big check. But we can help you minimize the taxes by planning. The best way to reduce your tax liability is in your record keeping. So for those who use the farm book, do you find that that's the case? If you open, if there's anyone around you that has a farm book, it's a very simplistic, simple program. I'll show you here. Each month has just a sheet, and every column looks pretty similar to the expenses that we have. You can certainly make your own columns if you need to write out, if you do something different than what we have here. Then on the right-hand side of this book, every day has its own line going across. I know it's not feasible to think that every day you spend money, you're gonna sit down and write it in this book. But if you could get in the habit, once a week, once a month, you're gonna find that when you fill this out, and then at the end of the year, you transfer that to this back page, back on page 60, whether you add it or whether you bring it to me and I add it, you've just, one, reduced your tax cost prep fee, because now I'm not spending 4 hours going through crinkled receipts that I can't read half of. And two, we know we have everything. But third, and most importantly, when we file that tax return and you get the letter 3 years from now from the IRS, we pull this book out. It happens, unfortunately. We pull the book out. The IRS auditor looks at us like we mean it. You mean what he said about you're running this like a business. You're not pulling out crinkled receipts that are fake. You have this record. Yes, the receipts that tag along with it might be faded. But this gives you the basis that you meant it. You ran it like a business. They take you more serious. In our world, we look at worst case scenario. Worst case scenario is the audit. The auditor is in a bad mood, like he said. He decides you really didn't use that much fuel. You don't have receipts to prove it. He's right, you're wrong. Even if you spent the money. And I don't doubt you spent the money. You spent the money. But if you can't prove it, he's right. You lose the deduction, you pay more taxes. This book is invaluable. You can do this in other ways. However, record keeping is instrumental in tax planning. And everything that Jonathan said was geared towards what works best for you. What reduces your tax liability? Here's where it starts. It starts here, and then you call your tax preparer, November, and you say, what do I do? So that's my whole message. We can go over this, we can go through this. I'll be happy to answer any questions that you have, how to make this work. My information is on the card here. The top paper that was paper clipped together is about the record keeping. Why it's important, what to do. The bottom of that page is about assets. Jonathan spent a lot of time talking about depreciation and what that does to you for tax purposes, because it really is beneficial turned ugly if it's not done properly. The worst thing that can happen is we don't have the right information, and then if you sell it for too much, but we didn't remember what we paid for it or something. The record keeping here, it talks about the assets and why, the information we need as a tax preparer that will help you the day you sell it. And that's ultimately what that's about. Does anybody use hired farm labor? H-2A workers? You may not need the second page then. There's a lot of things that go into farm labor and H-2A. If you ever need to get into that situation, that's what this one is. But if you don't have that, you won't need it. So I guess really, because I was told 10 minutes, keep it short for record keeping purposes, I'll open it up for questions. If anybody has questions about how this book works or questions about what I, as a tax preparer that sit with a farmer, needs that